What's up everybody, Gen X Dividend Investor here. In this episode, you'll discover how to use dividend stacking to create a self-growing, hands-off income stream that builds wealth automatically over time. I'll also share something I've never talked about before, which is my stock options and RSUs from companies I've worked at, not just the stocks I've bought myself. So to kick this off, I ask you the following. How amazing would it be if your money worked harder than you do, making more of itself while you played video games, watched Netflix, or even slept? Well, that's the power and the possibility of dividend stacking. It's a strategy designed to grow passive wealth automatically without chasing hype or staring at the stock market all day. And if that sounds too good to be true, then consider this. Since 1960, 85% of the S&P 500's total return has come from reinvested dividends and the power of compounding. Dividends can be a powerful part of long-term wealth building and a great source of passive income, which means earning cash flow without trading your time for money. They aren't magic, but they are real payments from some companies made to their shareholders, usually in cash, as a way of sharing their profits. Basically, you buy stock in well-established dividend-paying companies, which makes you a part owner. Then as an owner, the company pays you a share of its profits on a regular schedule, like monthly or quarterly. It's kind of like owning a donut shop and getting a portion of its profits each month. As an investor, you can either take that cash or reinvest it to buy more shares, which can help your investment grow over time through the power of compounding. I currently make about $137,000 a year in passive dividend income from my relatively conservative dividend portfolio. Now, it took me decades to get to this point, but anything good in life takes time and consistency. The good news is that you too can build a decent portfolio if you stick with it. For example, if someone earning the median income 30 years ago consistently invested 10% of their salary into a 401k, got a 3% employer match, reinvested all dividends, and earned the average market return, their portfolio could have grown to something pretty incredible. Like in 1994, the median income in the US was around $33,000 a year. If someone had invested $3,300 that year, got the match, and kept that trend going, then by 2024 their portfolio would have been worth over $1 million. And again, this is someone on a normal middle-class salary. Of course, 30-ish years of investing is a long time, but most people work for 40 years before they retire, so my point is that building $1 million portfolio is achievable for many people out there if they stick with it. Now, while most people will probably do better by investing in broad market ETFs like VU, for this I'm going to focus on what I did, which was invest in individual stocks. I mean, when I was working, I'd invest in whatever funds my 401ks offered, but I was also investing in single stocks and a taxable account. And then whenever I'd leave jobs, I'd roll my 401k into my IRA so I could invest into individual stocks as well, which is why I was always looking forward to leaving jobs. These days, about half of my portfolio is in my taxable, and you can watch my recent videos where I show you my entire holdings in Fidelity. I was looking at my portfolio recently and noticed something interesting. It basically has 3 types of tickers, almost like 3 layers of dividend-paying investments. That's actually what gave me the idea for this video. People often talk about stacks on stacks on stacks of cash, but I realize my portfolio goes a step further. It's generating stacks on stacks on stacks of dividends. And the best part is that those dividends usually grow on their own and produce even more cash, much more than idle money ever could. I also realized that my more conservative stable stocks are holding the whole portfolio up, so it's kind of like they're my base on the bottom. These are ones that usually weather tough markets, economic downturns, or anything else that comes along and still keeps paying out. In the middle layer are the companies with the most growth potential that tend to deliver good stock appreciation, dividend growth, or both, and those two often go hand in hand. And finally, the top layer is like the icing on the cake. It has my higher yielding tickers that make things even sweeter by adding extra income to the mix. In all, I get some cash flow, some growth, and some diversification. Now, the younger you are and the further you are from retirement, the more I'd focus on the growth layer, dividends or not, and then as you get older, then the top layer probably deserves a bit of love. If you do have dividend stocks, perhaps in a Roth, then you probably want your dividend reinvestment plans turned on to enable the compounding magic that can happen. I reinvested my dividends for decades until my income grew larger than my family's expenses, at which point I turned off most of my reinvestment plans, also known as DRIPs, and retired and started spending my dividend income. And since I retired early, that means I pay a withdrawal tax penalty on any dividend cash I take out of my retirement accounts. Now, another aspect to the stacks on stacks thing pertains to how often you get paid. Like, I have 28 tickers, 4 of which pay monthly and 24 that pay quarterly. And something interesting happened without me even trying, which is this. My portfolio now pays me dividends pretty much every week, sometimes more than once a week. For example, just looking at my 4 monthly dividend-paying tickers, we find that JEPQ usually pays in the first week of the month, O usually pays around the middle of the month, and DEVO and IDVO pay at the end of the month. Basically getting paid each week, and I still have over 2 dozen tickers that pay out quarterly. Like if I just look at this month, I was paid by Southern Company, ExxonMobil, J&J, Chevron, Microsoft, McDonald's, Duke, and Home Depot. And then later this month in June, I'll be paid by SCHD, Goldman Sachs, Pepsi, and Travelers Insurance. In total, I'll get about $11,800 of dividends this month. With all that said, how often you get paid doesn't matter as much as it might seem. I mean, sure, it's fun to get paid more frequently, and yes, the sooner you invest, the sooner compounding can begin. But what really matters is the total amount you earn over time, because you can always budget around that. Getting paid more often can be motivating and might make budgeting feel easier, but it's just as manageable to budget with larger, less frequent payments. Okay, now let's talk about some of the tickers in each of my layers. My bottom stable ones are things like Procter & Gamble, Coca-Cola, and McDonald's, aka classic dividend stocks. I'd also put good dividend ETFs like SCHD at this level. These types of tickers tend to have a medium yield, typically in the 2 to 4% range right now. I view them as foundational stocks that offer highly reliable income, characterized by low volatility and a strong track record of consistent dividends. Nothing is guaranteed, of course. All of those tickers are six-figure positions for me, but remember, we all started at zero, and don't compare yourself to me or to anyone else. And also don't just copy my stocks or what I'm doing. I mean, when I bought my stocks, the market was in a completely different place. On top of that, I have my own goals, risk tolerance, and timelines and such. Moving on, the next layer up in the dividend stack are stocks that have more growth. So for me, it's things like Microsoft, AbbVie, Goldman Sachs, and Travelers. My guess is that growers will increase earnings and revenues faster than the market average. And if they meet or exceed expectations, their share prices can increase significantly, offering higher capital appreciation than value or income stocks. These types of stocks often have lower yields, though AbbVie breaks that mold. They're the kind of tickers where reinvested dividends really shine because compounding just adds fuel to the fire. And while nothing's guaranteed, growth stocks usually have a good shot at outpacing inflation over the long term because their earnings tend to grow faster, which helps preserve and even boost your real buying power. You could also choose to invest your dividends in your non-dividend stocks, though depending on your platform you might have to do that manually. Like you could take your dividends flowing in and pile them into your Amazon position, which is a cool way you can potentially build your portfolio over time. The secret really is about investing at quality companies, ideally at quality prices. You know, companies that have strong, consistent financial performance, including steady earnings growth, high return on equity, and healthy profit margins. Companies with durable competitive advantage, such as a well-known brand, proprietary technology, or market dominance, all that helps it protect it from competitors. Quality companies generate reliable cash flows, maintain lower manageable debt levels, and are led by experienced, trustworthy management teams. They tend to be resilient through economic cycles and operate with long-term stability. And again, ideally you invest in them when they're at reasonable valuation levels, i.e. when they're not expensive. You can use tools like fast graphs to help you identify when a stock is expensive or cheap or reasonably priced, or you can learn how to value stocks yourself. Then moving to the top of the stack, where you may have some higher yielders. Now, high yield doesn't automatically mean high risk, but in my experience it's often true that the higher the yield, the higher the risk potential. You see, with investing, returns are the reward for taking on risk. Thus, when a stock or bond offers a high yield, such as a large dividend or high interest payment, it often reflects investors demanding more compensation for taking on greater uncertainty. That risk might come from a shaky balance sheet, declining earnings, unstable cash flow, or vulnerability to economic downturns. It might be because the company is in a riskier industry, or maybe one that's out of favor. And when companies are in financial trouble, their stock price tends to drop, which then drives up dividend yield. That increased yield represents increased risk that the market has priced in because the company's financials have been floundering. Like, think of sin stocks, i.e. companies in industries like tobacco, alcohol, and gambling, which tend to offer higher dividend yields because they generate stable, high cash flows, but may face limited growth opportunities and social stigma. Many investors avoid them, which depresses their stock prices and, in turn, increases their yields. These companies also face ongoing regulatory and litigation risks, so investors demand higher returns to compensate for the added uncertainty. And since those types of companies often don't reinvest heavily in expansion, they return much of their profits to shareholders through dividends, making them attractive to income-focused investors despite their controversial nature. That risk-return principle is very clear in bonds as well. Like government bonds are often low risk and thus they offer low yields, while junk bonds have high default risk and thus offer much higher yields. Investors require that premium of yield because there's a bigger chance they won't get the return they want. So higher yield isn't free money, it's usually a signal that something about the investment carries more risk, whether it's credit, market, or operational risk. My highest yield tickers include my sin stocks, some energy stocks, and my income ETFs. Now, income ETFs have their own interesting nuances and risks. Like maybe they have higher fees, so your actual yield is a bit less than you might expect. Or maybe they're doing option strategies, which can be conservative or aggressive, each changing the risk profile you face. New investors often gravitate towards stocks or funds with very high dividend yields, thinking they're getting more income for their money. But again, in many cases, a high yield is a red flag, not a bargain. Perhaps the company has an unsustainable dividend, so its stock price has been crushed, driving its yield up. And if the dividend gets cut, which happens frequently with weaker companies, then the investor ends up with both a lower income stream and a probable capital loss. That's why I say to be careful to not tunnel vision on yield and instead focus on the quality and stability of the underlying business. Bottom line, high yield doesn't always mean safe income, and blindly chasing it can lead to owning risky, deteriorating assets. But high yield can also be relatively safe, so like always, you gotta dig deeper. Smart investors look at the full picture, including balance sheet strength, cash flow, dividend coverage, business fundamentals, and the market. Tickers in this upper stack often have yields in the 6% plus range, generally speaking. You need to be careful not to overweight this layer because it's the frosting, not the cake. And the younger you are, the less frosting you need, right? For reference, about 20% of my portfolio is in the 6% plus yield range. That's about my risk tolerance and hits my goals, though some people get more aggressive and go with a higher weighting. Everything has its trade-offs, and just because I do something doesn't mean you should. Okay, now let's talk about how reinvesting your divvies can really get them to stack and build your passive wealth automatically. This is a tool I built in my dividend spreadsheet product that I call the Portfolio Growth Simulator. I put in a starting portfolio value of 25 grand at an average weighted starting dividend yield of 4%. I assumed a 5% dividend CAGR, and that inflation impacted your buying power by 3% per year, and that your share prices increased by 5% per year. You can see that initially you'd be making $1,000 a year in dividends. Also, don't forget that you may owe taxes on your dividend income. What you can see is that by year 10, and assuming you were reinvesting your dividends, then your portfolio would have grown to be almost $43K, and it would be yielding about $1,700 a year in dividend income, adjusted for inflation. So your buying power would be 70% more than it was initially, without you doing anything. Your dividends were reinvesting automatically, perhaps in a Roth, and your wealth, both in terms of cash flow and net worth, went up on its own. And not only that, but the percentage ownership in the companies you reinvested in was also pushed up. Plus, if your companies were doing buybacks, your percentage ownership would be going up even faster, or if they were issuing shares, then that would act as downward pressure on your ownership percentage. But generally speaking, good companies tend to buy back their shares, so you as a shareholder keep owning a larger part of the company. So while it might sound inconsequential to own 0.001% of the company or whatever, the reality is that as decades of reinvesting go on, then you could end up owning a lot more of it. Anyway, as you look further out in time, the less estimates tend to be accurate, but this can still give you a flavor of things. If we jump ahead to year 50, we see that the 25K portfolio could have grown to 457K, inflation adjusted. At that point, your DRIP could be yielding over 18 grand a year, so your buying power would have increased by 18-fold. It's fun to think about opening a Roth and then putting some solid dividend growth stocks in it, turning the reinvestments on, and then watching how the compounding plays out over time without you doing anything. They say that the best stock portfolios are held by dead people because they aren't constantly mucking with them. But you also have to realize that some stocks can go under, and that's one reason why ETFs are often considered safer than individual stocks. Hopefully this visually shows you how you can build passive wealth automatically beyond the initial buy. And here's an example of my personal portfolio's estimated dividend income over the next 10 years, with the blue bars showing if I'm not reinvesting versus the red bars if I am. And it really shows you how reinvesting dividends can increase your passive wealth automatically. And then this is if we look 35 years out instead of just 10. The red line, which is the reinvesting dividends line, shows you how your dividend income can grow so much faster over time. Now I'm spending my dividends, so I'm more like the blue line, or actually I might be between those two lines, but closer to the blue line, since I'm reinvesting about 20% of my ETF's divvies back into themselves. Of course, if my companies cut or stop raising their dividends, then these lines could change. Regardless, this chart helps highlight the dream of being able to live off dividends eventually. But you can only get there if you start investing in stuff that is strong enough to flourish and grow through the test of time. If you chase too high of yields with too many stocks, like if your top icing layer is too big, then that tends to increase the odds of hurting your portfolio. If you ignore the sustainability of your dividends, like your payout ratios and such, then that too can kill your portfolio. If you don't have enough diversification, like maybe you're way too heavy in one sector, then that too can increase the risk in your portfolio. And of course, not reinvesting your dividends is not smart unless you really need the income. Plus, make sure that you control your emotions, as that can be a big risk to your portfolio success. I mean, if you get too freaked out and you sell during market crashes, then you probably are increasing the odds of not doing well over the long run. But if you keep investing in decent stuff and don't get scared out of the market, then I'm confident you'll do well over the long run, and I'm also confident that you have a great chance to become a millionaire. I've met a bunch of investing millionaires through social media, and the more I chat with them, the more similar patterns I see. Like, millionaires often set long-term goals and stay consistent in working toward them. They stay focused and treat delayed gratification not as a sacrifice, but as a strategy. They understand the quiet power of time and compounding of good assets. Millionaires know that wealth comes from owning assets, not from saving all their money in the bank, and definitely not from buying things that tend to depreciate over time, like cars or boats. Thus, millionaires often stock assets like good cash flowing dividend stocks and/or real estate and/or businesses. And beyond assets, they also stack relationships as they constantly look to expand their network. They stack skills to keep learning and growing. They set a clear vision for where they want to go, and they don't blindly listen to naysayers who say it can't be done. Take a listen to this 30-second clip to hear what I mean.
But I didn't listen to those losers. I didn't listen to them at all. It's just the reality of it is that you cannot listen to the naysayers. So this is a very important lesson for all of you. So when someone says, no, this is a stupid idea, you in your mind, you don't have to say it, but in your mind just say this of you asshole. What do you know?
In the end, you can stack your way to success, regardless of what others believe. That doesn't mean you shouldn't listen to others, just don't ditch what feels right to you without thinking it through. Moving on, now I want to share something I've never talked about before, which is the stock options and RSUs I've received from working at companies, not just the stock I've bought myself. And for reference, stock options and RSUs are two common ways companies give you a piece of ownership. With stock options, you're granted the right to buy shares later at a set price called the strike price, usually after you've worked there for a while. If the company's stock price goes up, you can buy low and potentially sell high. RSUs, or restricted units, are a bit simpler. You don't buy anything. The company just gives you shares once they vest, and they're worth whatever the stock is trading at. Both are ways to grow wealth, but they work a little differently in how and when you get value. My first job was for a relatively small company, but we eventually got acquired by a company, and through that process they gave each person a bit of stock. I was on the bottom of the totem pole and got 10 shares, where each share was worth about $30. Well, I was actually one step above the bottom, since the bottom were interns who technically weren't employees. One cool thing that place did was that they actually gave us a physical stock certificate. But the best thing for me about working there was that's where I started investing in the market, both in a 401k and in my own taxable account. I was there for a few years after college in the 1990s, until a relative of mine suggested I join a startup he was working at. I felt kind of burnt out where I was, and I thought it'd be fun to try something new, so I left that first career job and joined the startup. There I was still programming, and then expanded my skill set by doing some project management stuff, and they gave me 5,000 shares that vested quickly, though it was a private company so those shares weren't really worth any cash. And once again I was near the bottom of the org chart. But we underlings had dreams that the company would IPO at $100 a share or something, because this was before the dot-com crash and we saw how tech companies were IPOing with big numbers. Unfortunately the market blew up before we went public, so all those shares ended up being worth nada. The next job I got was at a public company, but I didn't get any stock. Once again, I was near the bottom of the org chart, but as the years went on, I moved up and eventually got my first management gig, but that still didn't get any stock. I stayed there for many years until I heard about another interesting job opportunity in town at a much smaller public company. This place offered me 10,000 options, and the stock was like at $5 a share when I joined, so that seemed cool. And they had a 4-year vesting process where each year that I remained, I'd get another 25% of the shares. So I joined and moved up the ladder, and the stock went up for a while. But the place was a crap fest, and it turns out that they offered me more compensation because the environment was so toxic. Like, they didn't tell me that people were quitting faster than they could hire them, and that's why they started dangling more stock to get people to join. Looking back, one of my bigger mistakes, aside from staying in that overly stressful job, was not selling most of my shares when they vested and the stock was up. I actually wanted to sell, but the higher-ups made selling feel like something to be ashamed of. Now, at the time, I had no idea if the CEO or CFO even had visibility if we sold shares, but the crazy CEO was super unorthodox and would yell at people in meetings and say they were idiots if they sold their shares. Over the years there, I got a few smaller stock grants, some of which were options and some were RSUs, but it wasn't like the stories you hear about at Google or Apple, where people make millions of dollars in stock or whatever. I actually checked their stock prices as I was working on this part of the video, and it's under $10 a share. After that place, I went to another public company, which offered me 1,000 options at the stock's current price of $50 or so. Unfortunately, that stock didn't go up any, so the options were worth zero, and I ended up leaving them due to some health issues I had, but fortunately I had dividend income I could fall back on. After that place, I briefly supported a startup founded by a former colleague I trusted and had worked with in the past. He gave me some stock for helping out, which I still hold, but I'm guessing that will go nowhere as most startups fail. In the end, everyone faces their own unique tailwinds and headwinds, so don't waste time comparing yourself to others. The key takeaway though is this: you can still build a strong portfolio without any big wins if you stay consistent with small contributions over decades. Focus on how you're going to achieve your goals no matter what setbacks come your way. Even if you don't hit $1 million, it doesn't really matter. $1 million is just arbitrary. What matters is that you set goals, face your setbacks head on, and keep moving forward. Focus on pushing yourself toward long-term wealth. What really matters is that you're on a solid financial path. I like using gym analogies in my videos because I'm a big fan of working out. So think of investing like lifting weights. Most people don't walk into the gym expecting to squat 405 pounds on day one. You show up, you train consistently, and you get stronger over time. Some days you plateau, some days you hit personal records, sometimes you get sick and lose progress, sometimes you get injured and face real setbacks. Maybe you can't even squat anymore. But you don't give up. Maybe you're in a wheelchair, but you still wheel yourself into the gym and train what you can. Don't let setbacks define you. Define yourself by how you keep going in spite of your setbacks. And that's what really matters. Not how far you go, but that you keep going. And it's the same with investing. Make consistent effort your goal, not instant perfection. Keep stacking, keep growing, and you'll build your wealth. And with that, I'd like to close things off and ask you to please do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Moving on, and as a way to show my gratitude to people who leave really nice comments, I'm going to give a shout out to 10 subscribers who've done just that. So thank yous go out to Eastwood Finance, El Dynamico 2022, Brian Peak, Captain America 3139, Jetfire TF76, Gregor F. Hands 3S772, multiple nice comments from Major Sam 83, multiple from Olesia Kalu Garu 9503, multiple from Walter Ramirez 3287, and multiple from Julio Rodriguez 6097. Thanks folks, I really appreciate it. Now I'd like to recommend that folks check out my Seeking Alpha affiliate link, which has a sale running right now where premium membership is $60 off, which I think is a great deal. Next, I'll pitch my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Patreon page, or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.